Hello and welcome to the latest update of the long and short portfolio. What you see in front of you, the same old boring chart with a few changes. And why don't we go over them? What has happened over the last couple of weeks? The last video around the 14th of March, this is where it would have been. It's been a solid couple of weeks since then. A lot has happened. The reversal, obviously, well along the way, seemed to be down 8.5% since January 7th. Um, well, okay, I am not down 8.5%. I'm actually broke even at this point in time. The combined ROI is around zero. That calculates into a negative 837 on the long only portfolio. As you remember, 2 weeks ago, I had left gold in communications in that account, long only. There were a bunch of stocks in there, but I trimmed it right back after February 25th. If you go back to 2 weeks, no, 3 weeks ago, and 4 weeks ago, I was talking about reversing because of what's going on in the markets. And I reversed actually a couple of days before the invasion of Iran, which was, yeah, um, it was coming. It was definitely coming. It's not something that just came out of the blue. Let's go to the chart that made it all happen. This is it right here. If I zoom in, this would have been February 25th, and I started making my changes that week, finalizing everything on the 27th, and nothing has changed. Everything is actually just put in here in the notes, so you can see absolutely everything I've been doing. But let's go over the changes for the last couple of weeks. There are some big ones. As you can see, these closed positions here. Going back, let's go back to February 25th for a moment, and let's just go with that. As you notice, February 25th is where the ranges hasn't crossed over, but it was so close to zero. That was the signal. I mean, it's been sliding down and it's continuing on its downward trajectory ever since then. Meaning the momentum of the positioning of the investors in the market is turning bearish, or has turned bearish. This is 4 weeks now, over a month, and the accelerating momentum was at 24.5% on Thursday, meaning that there's more and more sellers in the market. And what drives the markets? Markets get driven by sentiment. The book called The Socionomic Theory of Finance by Prechter is a very good explanation of that for those of you that can sit through and listen to that book or read it. I do have a copy of it. It's a great book on what actually moves the markets. The Socionomic Theory of Finance. It's not an easy one, but it's an eye-opener. All right, so ranges. The February 25th made me turn, and if you look over here, this is the February 25th happens to be that peak right there, and ever since then, the market's been on a downward spiral. Meaning this does not work on its own like it did not over here or here. What's necessary is a catalyst behind all of this, so the positioning itself is not the ultimate indicator here. The positioning of the investors in the market is, and so the momentum combined with a catalyst is it's like a perfect soup. And with a war, I was thinking gold is going to outperform, and so should communications as defensive sectors, and those have underperformed severely. So let's go back to what happened over the last couple of weeks, because I've trimmed my gold exposure considerably. So Iran happens, and then we've updated you up to here where I've closed off most of the long only portfolio, but since then I've closed off all of it. And as you can tell over here, since March 20th, I have closed off all my positions in the long only, which is zero floating. And you can see the account value is now steady 26,113. The reason being is that whenever VIX spikes over 25, which it definitely has. VIX currently is at 31.05. It's been ranging in there. Like this is where we started closing off the portfolio. And anything above 20 is already a danger sign, but anything above 25 is really when you don't want to be 100% invested. And so we are definitely not. I've reduced the long only portfolio down to zero. I don't want any of that exposed because I don't know what's going to happen. The market's been so volatile, up and down, up and down. The best you can do is to come up with another set of trades that actually does perform well in this, and this is exactly what I've done. I've gone to FinWiz and I've isolated the stocks that are outperforming. If you look at the market itself, we'll go to the maps. Uh, there we go. Here's maps. Never mind. And if you look at, this is just the S&P 500. Let's look at all stocks, meaning across all the indexes. You see a lot of red on the 1 day performance. You go to 1 week performance, we still see a lot of red. We go to a 1 month performance, and there's even more red. The only thing that seems to be sticking out over here and doing well, other than telecom, which I tried, but those didn't turn out so well either. The only thing that does seem to be doing well is obviously oil and gas. Whenever there is turmoil in the gas industry, like this war has caused, obviously their prices are going to go up, spiking their profit margins. And so I've replaced my gold positioning, or my big chunk of gold positioning. I've turned back and I've returned Barrick Gold and IM Gold into it. I do want some gold exposure. I want to keep a close eye on it because ultimately I do believe gold is going to start climbing back up. It's not something that I was expecting. I mean, in war times, gold usually goes up. It did not. Whatever. It is what it is. That's why we don't put 100% of our money in one single basket. And I had some losses, but it's overall for the year since January 7th, 2026, I am flat. Now, let's speak about the long only. Long only is looking at -3%, or minus $837 with an alpha of almost 5%. Now, the S&P since the same time of January 7th is down actually 8%. My long only is down 4.87, and that's represented by the charts. If you look at long and short portfolio, this is my return, that's the S&Ps. And then if you look at the long only, every time S&P goes down, the long only will go down a lot more because a lot of the stocks that I own are high beta stocks. As high beta stocks go up a lot faster than the S&P, they also fall a lot faster than the S&P. So you can see that I've gone flat in this portfolio right here, and the S&P is still sliding. I am going to be looking to adding to this portfolio and opening it back up once the sentiment starts going positive and I actually start seeing some good news in the making. Because right now, with all this conflict, there obviously isn't much. With a lot of news coming out saying that, oh, we are reaching an agreement. The other side is saying we're not even at the table talking to each other. There's a lot of up and down, up and down, up and down, and like you can't really decipher what's real, what's not. The best way to do it is to go along with what's happening and try to position yourself as defensively as possible in a time like this. Anytime there's VIX above 25 or let alone 31, like right now, you have to reduce your portfolio. If you don't believe me that that's what I've been talking about, go back a few videos back. It's I'm not the best public speaker. I don't do well in front of camera, but this is exactly what I've been talking about, and I've been following this indicator like a hawk. And I started talking about this over here when it was reducing, and definitely on February 25th, and the video would have been out on the 28th or whatever. I said specifically we are turning around because this is turning negative with the war looming. I don't see good things coming, and ever since then, this has happened in the S&P 500. Now, we're not in the bear market territory. Gold is, silver is, but I'm not paying attention to those so much since my exposure has gone down. What I'm paying attention to is the S&P 500. Now, S&P 500, it has a bull, so it's currently still in the bull market. We could still see a rebound, but with all the geopolitical stuff that's been happening, I kind of don't see that happening. I see this thing going lower, and so far there's nothing that tells me otherwise. So back to the S&P. This is the current price of the S&P 500 at 5601. I wrote that number down. 5601.82 cents. That is the level of the bull market. When we reach the 5601.82, we are officially in the bear market for the S&P 500, at which point in time we could go lower, it could go. There's going to be a lot of positioning reshuffling at the time, but we're not there just yet. Mind you, it may happen over the next few months. But one thing I want to mention, there was this prediction. I think it's like 100 years old by now. Somebody wrote about market cycles, and they've actually predicted that 2026 is going to be a really bad year for stocks. And they're saying to, I forget who it was, but do I have it up somewhere? No, I do not. Maybe I'll bring it up on the next video. I'll look it up. I'm not going to look for it right now. It just came up, but they are saying that 2026 is a very good year to sell things. And so inevitably, there'll be a good chunk of people out there following the same predictions, and they'll be closing their positions, pushing this more. And so, yeah, so far 2026, it started off with a bang. I was up quite a bit, and then I've lost all my profits for the year. Currently, I'm sitting flat at 0.03%. The return between the two portfolios, long short and long only, is only $11. But we have survived. We are slowly building back up, with the long only being completely closed off, and then long and short rebounding back into the 20s at this point in time. What made that happen? Obviously, the big drop was my large exposure to gold, which didn't end up going into fruition. But let's go over what happened for the last couple of weeks, just so you know exactly what I've done. And then if you ever doubt me on what I'm saying, you can go back a couple of videos. I always go over this. I write down everything that I've done that day. You can pause this, go over it, see that I'm not lying. I'm not telling you to buy any of these stocks. This is what's just in my portfolio. What I'd like you to do is maybe learn something from this, and then apply it yourself, because this is not hard. Anybody can do this, and as long as you do these things in a way that it makes sense, you can't just pick stocks because a thing flashed green or red. You need to look at their fundamentals. And in these videos, we'll be going over and over and over this stuff every single time we do this video until this just sticks in your head, and you'll be able to open up a website like Seeking Alpha or Stock Market, go to their screeners, and choose the stocks on your own. I mean, just by filling in a few fundamental things like I've been showing in the videos, there's a few things that you can click over here to narrow down a list of thousands and thousands of stocks to a list of like 100, which are outperforming the rest of the market. So, but this is not a video about that. We'll get back to doing that again. Let's go back into the long and short. And so on Monday, 2 weeks ago, today is Saturday, March 28th. On Monday, 2 weeks ago, I had covered CCHGY, lost $3.50. Covered GSL, made 26 bucks. Covered RNG, lost $9. Covered PDLB, lost $19. Covered BCS, made 67. Covered API, lost 11 bucks. And then I bought Fastly, 23.64. On Tuesday, I bought 12 Unify at 41.17. And then on Thursday, covered Barrick. I actually covered Barrick, covering all the gold portfolio. And like, this is, you can see that all here, but covered Barrick gold at -10. to maintain the margin. Pretty much I had too much exposure and they were calling to increase the maintenance margin, so I had to reduce a few stocks there. Bought 12 ICO, bought 12 USO, bought 10 BNO, and bought 3 VICR. VICR is a industrial stock. The rest of these BNO, USO, UCO, these are oil ETFs. Like I said, I've noticed that oil, if we go back to our maps, oil has been outperforming. Let's just go to 1 week performance, and you can tell that oil has been outperforming. It's in the green. Utilities have been doing okay, basic materials, whatever. But oil, if you look at a month, 3 months, whatever, 1 month performance, that's the one that keeps on ticking in green. And so I have taken on some oil ETFs, waiting for the oil to spike. And what am I going to be doing with that is if there's major development in Iran, the oil is going to spike. It could go up to 200. All these ETFs, which I have quite a bit of exposure to now, if you look at it, there's 1, 2, 5, 6, 7, 7 stocks altogether. And if I put them together, that is 46.67% of my long only allocation. On the short side, my biggest exposure is software application and packaged foods and software infrastructure. So software itself represents 40% of the portfolio. Um, and over here, you can just see what I'm going long, what I'm going short, and then the allocation long and allocation short, just to see where the bulk of the money is being applied. Uh, on Friday, I've covered all of my long only portfolio. The gold was failing to be a safe haven, and mining stocks being leveraged with gold exposure. Sorry about that. So with the mining stocks being leveraged as they are, they were losing money quite a lot faster than the gold was. And so the idea was if it ever does get to zero, I will trim those right down. I waited a little bit too long, hoping, getting greedy. The gold's got to turn, and it's got to rebound, and it's going to go back up again. Guess what? It did not, and so I ended up closing all of my gold exposure in the long short portfolio, and I replaced it with oil. Now, this week, not much has happened. The reason being that this week, much of the market has been flat. If we look at Forex Factory calendar, this is this week. Not much. There's flash manufacturing PMI. It's just a preliminary number to the manufacturing PMI coming out on the 1st, which is coming out next week. Unemployment came in line. Flash services PMI. I don't really pay too much attention to these two. What I really pay attention to is ISM manufacturing index and this service sector, which comes out on first Thursday of the month, which will be next Thursday, I guess, at this point in time. But this is what's happening next week. And I have this so that only the most important red announcements are there. This is actually a great website. You can see you can see the graphs, how the past performance has been. You can read about what this indicator is and where the data comes from. This just allows me to organize it all very nicely and set up alerts, meaning that if I'm looking for a specific number, or if I'm looking at a number in a VIX, it goes up, it goes down, it goes up and goes down. Nobody knows where it is, but if it goes up and I'm waiting for the number to be above 25, I set my alert, this little bell here, to be at 25. Whenever that number comes out or that number goes through the threshold, I'll get an email and a text alert from this website, which is great. This is free of charge as well. You just subscribe, and then puff, every time something happens, you get a nice email saying, hey, that line has been crossed, pay attention. So that's where I look at my calendar. That's next week. And then this week, once again, there wasn't really much, and so I wasn't doing too many things with it. But on Friday, yesterday, I covered VICR and I covered ISSC. Those were both industrial stocks, not performing too well. I replaced them with gold, meaning I don't have enough gold exposure right now, and with the prices of gold being as low as they are, down than more than 20%, this is actually a potentially a very good entry point for gold. And so I wanted to up my gold exposure, so I bought a couple of stocks. This brings it up to like $900 of exposure across the whole portfolio. It doesn't really do much. It is what it is, and if it does well, it does well. If it doesn't, it doesn't. Is it going to hurt me? Probably not. Okay, so back to long only and long short. Long only, now long short, we're looking at 16.5% return. Long only -3%. Since then, same time, S&P is down 8%. So if you look at my long short return, even with all this gold exposure, even with all the losses, even with all this crap that's been happening lately and instability, I am still up 16.5%. I am doing 24.5% better than the market itself. I'm up 24.5%, and these guys are down 8. The long and short is the way to go. Long only makes really good money. Yes, it does. There's nothing wrong with long only portfolios, only at the right time. If you are long only all the time, you're going to see violent swings up and down, up and down, up and down. And if you're using leveraged products, leveraged ETFs, leveraged stocks, you will end up losing a lot more money a lot faster when you don't have that short exposure. And so this is the evidence of that. And just look at the two charts. That is why I put them down here, just so you can see long and short, being greedy with gold, which I shouldn't have. I should have just gotten out and let it be. I have repositioned. I'm more defensive now, and it seems to be starting to make money again. Now, when the market turns, this will stop working. This will still be flat, but the market will start going up, and that's my cue that the sentiment in the market is improving. And then I'll go back to ranges, and I'll look for that confirmation that the actual sentiment matches the momentum in the sentiment, because it's not really the sentiment that drives the market. It is. It is. It's the sentiment is driven by people, by traders, and that's what you really need to follow. But at the same time, not the absolute number. What we're really looking for in stocks is not absolute numbers. We're looking for what's called rate of change or momentum. Like how quickly are the numbers changing in our favor or against us? And is it stacking up to be faster or is it stacking up to be slowing down? As you can tell, the momentum is on the positioning or the sentiment is definitely negative. Doesn't seem to be slowing down. And so at this point in time, I'm not looking to change my positioning. When this starts reversing, I will look into the performance of the entire portfolio, and if something is lagging, I will be replacing with something that seems to be doing better at that time. And that's really the most important thing. You don't want to be stuck on the wrong side of the equation, holding the wrong cards when a taxpayer comes asking for money. I don't know if that's the right terminology, but whatever. Um, Ever since February 25th, which happens to be right up here, we've set up to go south, and it hasn't disappointed. Now, there are a lot of people out there that are making big mistakes, not knowing what they're doing. They're putting all their money into single baskets, and I know some people personally that are scared to put their money out there because they've lost like 40, 50, 60%, and it's not pretty because you don't follow the principles. When the VIX is up and high, you got to reduce. Um, you gotta, well, if you're already diversified and if you're already working on your portfolio, setting up defensively, you're doing a lot better. But you still need to trim that exposure because as much as defensive may be right for now, what if tomorrow somebody comes out and say, hey, the war is over, and then all of a sudden the spike happens in the opposite direction. You have to, whenever the VIX is up high, anything above 25, reduce the exposure. Do not have too much in there. And if you notice, my long only exposure is at 0. The long and short combined is at 13.894. Yes, that's like 90%, of everything that's in there. But this is a small portion of what the whole portfolio is at. That's 32. $0.3 thousand. This here is like it's only like $6,000. Like that's the long only account value. It's the fact that I'm selling and buying at the same time, meaning that I'm borrowing the money or I'm being lent the money, and that allows me to expose myself more in that one. With $6,000, you can have $14,000 exposure. That's because of the long and short exposure at the same time. So we've covered what actually happened over the last couple of weeks. We've covered the graphs. Uh, we're flat right now. The combined alpha, I mean, the return for the year is still 8%. That's only because I'm outperforming the S&P by 8%. But if we go over our stocks over here, maybe let's just go through this. Just quickly go through all the pairs. Never mind, never mind. Let's go through a couple of others first. Before we go what's in the portfolio, there's been a couple of pairs which I've used one of already. We're gonna open this one. And then we're gonna open XTR. That's VSCO. So you'll notice a couple of weeks ago, I've picked these things. There were a couple. There was VSCO hubs, NXT, MSTR. So really, since then I've added hubs to the portfolio, and I've added NXT, basically based on their performance. These two were never entered other than those two trades, this one and this one, and I got hubs and NXT. But these were just hypothetical trades that we've entered to show you how this stuff works. And if you look at Victoria's Secret versus HubSpot, HubSpot remained flat more or less, whereas Victoria's Secret returned less than it lost $100. The total return is minus $98.20 on that trade. But if you go to NXT, Next Power to MicroStrategy, that profit is at 84.82. So one of them made money, the other one lost. I picked hubs and I picked NXT, and I've put them into the portfolio. You'll notice them. I go back to the summary. NXT, where's NXT? It's right there. And currently I'm down 4.5% on that. Hubs, I'm up 0.61. So not a big thing, but I've added those just recently, reshuffled the portfolio. This is exactly what's in it. Long, short, long, short, long, short. That's the overall exposure of how much money I have in everything. Currently, my biggest exposure, I guess, it's in Barrick Gold, $655. That's where it's sitting. And yeah. My biggest maker, long weekly return would have been this guy, consumer defensive food distribution. That seems to be outperforming this week. And then what else is outperforming? That's pretty much the biggest mover this week. Other than maybe this one, technology, information technology. What is that? That happens to be USO. USO. No, only 843 team. USO. It's oil. It's oil versus technology firm. But that's exactly what's in our portfolio. What else do we need to go over? We've been over the calendar. We have the ISM report coming up, like I mentioned. If you want to look at that report, it's right here. This is more detailed. It shows you a recovery in the U.S. economy, but this is not an absolute thing. I mean, this could be up and we could still have a recession. But this is a really good indicator. It shows you where the opportunities are in the market. VIX, obviously elevated at 31 currently. Ranges, we've been over that. Long and short, S&P 500 map. I think we've done pretty much of it, everything that, long only. If you look at my positions, this is another way I track my portfolio. If you look at it right here, This is exactly what's in my long and short portfolio. This is exactly how many days I held, which sectors are in. I have two of these. One of them is in Google Sheets. One of them is on Alpha, Seeking Alpha. I find that I have a couple of things that I like to look at, which are not 100%. I'm not 100% perfect. I mean, happy with the way Seeking Alpha does it. Maybe they'll improve it in the future. Maybe I can suggest that to them as well. But those we'll get to as well another time. But here I can track the performance, pretty much all kinds of metrics. And this is just things that I look at upcoming announcements, when under earnings, how they're doing, and the ratings. And a lot of time I spend in the momentum looking at what's been up and what's been down, year to date, 1 week, 1 month, 6 months, 1 year, 3 year performance, 5 year performance. Just in the long, you want more green, and obviously in the short, you want more red. That's essentially the rule of thumb. This is just the short side of the portfolio. You can see it's all red, because we're hoping for it to all go down. And when it does, we make money. So let's go back to the left. Those are the stocks. Those are the same stocks you're going to see in the long and short portfolio spreadsheet. And yeah, this is the return down here. Same numbers, just two different spots. I have to add it a little bit more, but what this allows me is this allows me a bunch of technical analysis, allows me a bunch of analysts articles just by quickly, going to my portfolios and then looking at the news behind them. Because down here you have the latest news pertaining to just these stocks. And then the latest developments sometimes are really hard to find, but when it's all neatly organized like this, you have your latest, you have analysis, news, warnings, transcripts for the earnings, press releases. All these articles will populate, and you can look at things that you're interested in, and they are all related to what's in the portfolio itself. So you're looking at the stuff that really matters to you. And that is why I keep a separate copy of the portfolio in Seeking Alpha, because it makes the news easy to get, and I don't have to go through all kinds of sources. I just have it all in one location. And yes, a lot of it is independent. It's not it's not big news, that I'm reading. But at the same time, when you're looking for unbiased opinions and views from outside of the box, I find that this is probably the best, because there's 100 guys out there like me who are doing these things, and they're willing to share their experience, and they're willing to share their analysis. And their hope is that you follow them and you pay them to do this for them in the future. So they give you like bits and pieces of it for free, and like just getting that stuff for free is absolutely amazing. That's what makes Seeking Alpha so great, is that it puts it all together, and you can have so many different conversations about why to buy or why to sell something, and then make a decision on your own, which is absolutely great. So for the amount of money that Seeking Alpha cost me a year, this is a great service. And this website here, it's nothing short of amazing. The developers of this thing have done a really good job. So you can see that the portfolio long only market was down on Friday, but I'm up 1.14, and I'm down almost up 3% on the short side. Long only doesn't have anything in it right now. Margin has these, and long has these, margin long and margin short. So I think that covers it. Should you be fully invested right now? Absolutely not. Is it good to have some oil exposure? 100%. I'm not sure what's going to happen to gold, so that's why I only have a couple of positions related to gold so far. But I'm waiting for gold to rebound in a big way, because gold actual value for gold is something around like $21,000 US. It's not five, it's not four. The value for gold, as it should stand today, it's over $20,000 US, and so I see gold going up. If this conflict in the Middle East keeps on expanding and getting worse and worse, gold inevitably will go up. And yeah, slowly but surely I'll be increasing my gold exposure based on that. Is there anything else we need to talk about? I don't know. I think I've covered pretty much everything. I mean, it's the same spreadsheet. Um, yeah, I think so. I think so. I think so. I think that's pretty much it for the for this week. If you haven't subscribed yet, please do. This is a channel where we prove that anybody can trade. Um, just don't do it the wrong way. And the wrong way is to put it all into one thing or to follow next guy on the news because he told you to do this or that. And there's a JK on Jim K or whatever, or C. I'm not gonna say his name, but yeah, I would never follow that guy. Honestly, like 90% of what he says, if you take the opposite of it, it will you'll make more money. So if you just don't do opposite of what the guy says on TV, you'll actually make money. How funny is that? It's because he gets paid to smear some soap in your eyes, and that's why. Well, you guys have a great weekend. I'm going to go ahead and just upload this thing. There's no editing in these videos. I don't care if I said some bloopers, really doesn't matter. Wish everybody a great weekend. Happy trading. Don't put everything in one place. Please don't. Try to do it this way. This is way better. If something gets hit, you don't lose everything. You just lose a little chunk. Gives you another chance to survive and live to fight another day. God bless, be well, and we'll see you on the next one.